Good afternoon, good morning, good evening, everyone. Thanks again for joining us today for this webinar, and thanks for our esteemed panelists for being here today. I think we are ready to go. We've got the live stream up on LinkedIn and participants here on the webinar platform as well. So every year, the Climate Bonds Initiative and the Inevitable Policy Response put on a webinar to tackle kind of different and emerging topics. And this year, we're talking about policy, which is on everybody's lips. And we're looking into the climate policy developments on the year. There have been many, and the gap, where do we want to be? Where do we have to be? Is it too late for meeting 1.5 degrees? So that's the key question of today. My name is Bridget Bull. I'm the Director of Technical Development here at the Climate Bonds Initiative. Before we start, a few kind of housekeeping points. You're very welcome to use your Q&A function. You can see it at the bottom of your screen. Please feel free to answer questions throughout the panel. We will have a little bit of time at the end for questions, but you know how these things go, we tend to run out of time. So please answer them throughout, and I'll try and bring them in as much as possible over the course of the webinar. So you're welcome to use those. You can see the presentation below, and you can exit the full screen mode if you want to see all the different tools at the bottom of the Zoom link. We will also send around materials to everybody who's registered in a follow-up email to this as well. All right, so I think that is the main housekeeping notes. As a reminder for today, the Principles for Responsible Investment commissioned the Inevitable Policy Response, lots of I's, P's and R's in those acronyms, in 2018 to advance the finance sector, investors and policymakers, and particularly on the awareness of climate transition risk, a phrase we are all very familiar with right now, but perhaps weren't so much in 2018. So IPR is led by Energy Transition Advisors and Vivid Economics, with expert policy input from CAIA Advisory. We at Climate Bonds Initiative are a research consortium partner, so we work together on various projects. So today we're going to hear from our very special panelists, and I'll introduce them in a minute. We'll hear from Kavita Srinivasan on the big policy developments in the first quarter of this year and the end of last year. We'll then look at the EU developments and implications of the newly announced Green Deal Industrial Plan, another acronym for you, GDIP, call it what you like. And we'll take a step back, look at the bigger term, longer term picture, and something that's been of much debate. We're going to save the key question, is 1.5 degrees achievable? We're not going to answer that at the beginning. We're going to answer that towards the end. Mark's going to take us through some of the work IPR have done and on the posts that he's been writing on the topic of overshoot. And we'll be asking questions throughout. So thank you for joining me. I have Kavita Srinivasan here, who's the Senior Engagement Manager at Vivid Economics. So she's joining us today. We have Brian Hensley, partner at CAIA Advisory. We have Alex Bernhardt, Global Head of Sustainability Research at BNP Paribas, and Mark Fulton, who's the founder at Inevitable Policy Response, and will take us through some of their work today. So very nice to see you all and have you all here today. So to start us off, Kavita's going to take us through a few slides of what's been happening so far. Now, somebody once told me that policy and the machinations of government happened at glacial speed, but that does not seem to be the case at the moment. Things seem to be happening thick and fast. And we're now not talking about what has happened over the last year, but over the last quarter, can you believe it? So things are happening very quickly. There are many things to keep track of and an alphabet soup of new policy developments to understand. Kavita's going to kindly take us through some of these, what's been happening in the last kind of 3 to 6 months. So Kavita, what are the big developments that have happened in Q1 so far? And I know you've got some slides, so
yeah,
if you need to
I'll share
have
some
time
slides I'll share some slides in just a minute, but kind of walk through some of the high level development. So when IPR examines quarterly developments, we look first at global announcements and pledges, and then we dive into regional assessments with a lens on, what's happening in OECD economies and as well as non-OECD economies. So starting at the global level this quarter, the key development here is the G7 communique earlier this month in Japan, where countries announced to accelerate both the phase out of fossil fuels and then in addition to increased deployment of renewable energy capacity. This included a target to collectively increase offshore wind capacity by 150 gigawatts, as well as solar PV capacity by over 1 terawatts by 2030. So for context, as of last year, there was around 60 gigawatts of offshore wind capacity globally, and then 1 terawatt of solar PV. So at least a doubling for both technologies by the end of this decade. In addition, the G7 agreed to achieve a fully or predominantly decarbonized power sector by 2035, and then prioritize concrete and timely steps to phase out coal. So when we see these announcements at the high level, these are the types of things we'll track over the year at the country level. And then if we look at the EU, of course, you mentioned the Green Deal Industrial Plan, which has really been viewed as the EU's response to the US Inflation Reduction Act, aims to scale up manufacturing capacity for net zero technologies. It's underpinned by 4 pillars. Brian Hensley from Kaya will be getting into the details of EU developments in the GDIP shortly. But if we move to the US, earlier this month, the EPA announced new federal vehicle emission standards. This includes thresholds for light and medium duty vehicles and is sort of associated with supporting achieving about 2/3 zero emission vehicle sales by 2032. So this could be viewed as this is definitely an increase in ambition compared to previous announcements from the US. Current goal was to achieve 50% zero emission vehicle sales by 2030. And, in the context of additional IRA funding for vehicle purchase and manufacturing capacity, we see this as really leading to an acceleration in EV sales that could outpace IPR's outlooks previously. Now, there are also new fleet standards for heavy duty trucks as well. So we'll be monitoring this closely. And then just noting here, this is the beginning of a rulemaking process. There's a consultation that IPR will monitor throughout the year. And then we also see the EPA is expected to propose regulations that would limit emissions from power plants, both existing and new. So this require coal and gas-fired plants to reduce or capture nearly all emissions by 2040. And as for the proposed electric vehicle rule, this would again be open for comments and of course with potential for legal and political opposition. So again, we'll track those developments there. If we move on to the non-OECD countries, some of the key developments this quarter rather, in March, India published draft guidelines for how it's going to operate its carbon credit trading scheme. They provided a list of eligible activities for generating carbon credits. This is under Article 6.2 of the Paris Agreement. And as a reminder, approval of Article 6, this is really the rule book that governs global carbon markets. This is a key outcome of COP26 back in 2021. So again, promising progress here. We're seeing advancement on development of both voluntary and compliance markets. And then finally touching on coal transition, India officially launched its carbon trading scheme. It announced quotas covering coal plants of a certain size. Now this follows the Just Energy Transition Partnership we picked up on last year. This includes a $20 billion package to retire Indonesian coal plants, deploy renewables, and overall help the country achieve its net zero by 2060 target. We saw similar announcements for partnerships in South Africa and Vietnam last year. So IPR will be looking for additional details that would support these. So this really provides a high-level overview of the developments. I'll note IPR has tracked additional policies from other regions, so I invite participants to visit the new webpage. We've got it summarized nicely here, hopefully in a bit of a punchier format from previous iterations.
Thanks, Kavita. Unfortunately, we didn't quite catch your slides. I don't know, they didn't quite come up unless other people saw them.
I didn't have slides. I'll bring some up later on in the session.
Okay,
yes,
great.
Sorry. Yep.
Okay, perfect. Okay, great. So that's that's a huge change in what's been happening and a huge more ambition that we've seen. I mean, I know Mark's going to take us through a little bit later on, what whether that's going to be enough. The IPR thesis says there's an acceleration in policy in action up to the 2025 Paris ratchets. So, on balance, thinking back over the last quarter, is this the acceleration we're kind of anticipating? How does it compare to what we saw in 2022 or where we were placed at the end of 2022?
Great, thanks, Bridget. And I will share a few slides here, so hopefully everyone can see that. Okay, so as I mentioned, IPR has been tracking policy developments and momentum since COP26. How close are we moving to a well below 2-degree aligned climate scenario, given announced policies, strategies, investments, technological innovation, deployment rates, and so forth. And so we systematically gather, screen, assess these developments. And here I've shared, hopefully everyone can see this, a distribution of policies that IPR has tracked this quarter. Now, I think I'll note here, IPR this year is simplifying its process for assessing policies, a bit of a more narrower, simpler scale, hopefully a bit more accessible to audiences. And then you can see here many announcements and developments in the green suggest that on balance, in fact, Q1 is reflecting momentum around a well below 2-degree scenario. Now, as to your question, does this reflect an acceleration? Certainly relative to the status quo, which we kind of capture on the left-hand side. This is sort of a lower likelihood of sufficient climate action. So yes, we are seeing global alignment towards the middle here, achieving a well below 2-degree temperature target. And now within this framework, certainly there are instances of acceleration and deceleration. And I think just to note on these signs of deceleration relative to 2 degrees, there is some anti-renewable sentiment, anti-ESG sentiment we've tracked in the US, some opposition, indicating some opposition to climate policy in certain states. And then there was an announcement we picked up. Germany's building new gas-fired power plants. They have announced these can be operated with hydrogen in the future, but it's something we'd like to track when we see those types of announcements. And then, as you see, sort of the acceleration is related to the transportation electrification announcements in the US, which we think are quite ambitious. And then how does this compare to the end of 2022? If I just move on to the next slide, here's a distribution of policies. IPR's tracked the past 5 quarters. Clearly you can see momentum, which is the sort of blue. We see the green momentum towards 2 degrees, but then some pockets of acceleration towards what we say is a 1.5 aligned scenario. As you mentioned, Mark will speak a bit later about what's really required to get here into net zero. And then finally here, just a distribution of all the policies we've tracked over the five quarters. So back to the IPR thesis, we expect an acceleration in policy ambition. Yes, we're seeing some momentum here. We're seeing alignment here. We have landmark policies that have been announced very recently. We see funding commitment, serious funding commitment towards fossil fuel transition, zero carbon manufacturing, and clean transport.
Sorry, struggling to unmute as always. Thanks so much for that, Kavita. That gives us a really helpful kind of assessment of where we are now. I'm dying to ask you some more questions about that, but I'm going to bring in Alex here to bring in some of the investor thoughts on this. Alex, from BNP's perspective, from an investor perspective, despite economic concerns, what are your thoughts? What's the view on the street, in terms of momentum from policymakers? Is there this momentum that Kavita speaks about? And, what do you expect? Do you expect more to come during this year leading up to the global stocktake at COP28?
Well, far be it from me, I think, to speak for the entire street, but I will try my best to put my crystal ball in front of me and give you a view on what I think might be happening. But I mean, for sure, there is clear momentum. I think well, friendly or unfriendly, I'm not sure which competition transatlantic across the transatlantic rivalry that we're seeing between the U.S. and the EU is much welcomed from a transition standpoint. We're trying, and one-upsmanship on that basis would be I think a positive outcome that many of us who are focused on the transition issues in the investment universe would like to see. But definitely, I do see some ramping up of policy action taking place prior to COP28. One of the things that makes me optimistic is that we've made some significant breakthroughs in COP26 and COP27 around the north-south loss and damage issue, which for me has been the biggest blocking point in the previous 25 COPs for further collaboration. There's a clear equity issue at stake here around climate negotiations that just hasn't even been at the table until very recently. I think also the focus in recent COPs around sectoral actors, right? I think was it COP 26 or 27? I can't remember which, where the first mention of sectors was brought into the framework, and so we're finally starting, I think, at the policy level to really address the issue in a more meaningful way. I think the war in Ukraine and the pandemic have both called out a number of other issues related to energy security and supply chain resilience, which have a lot of symbiosis or overlapping requirements with the climate transition. And all of that is leading to a lot more momentum. And so I will say that I'm much more optimistic going into COP28 and subsequent negotiations that there's going to be meaningful progress where actual dollars start to flow and more carrots and sticks start to get implemented that are meaningful and actually drive industrial transition. There are other reasons for potential lack of optimism. For instance, the $100 billion table stakes fund that the North had committed to the Global South back in the Paris Agreement still hasn't, to my knowledge, hasn't been fully funded. So I would like to see that at least resolved before COP28 in order to, again, continue this good faith effort of making sure that these issues like loss and damage and equity are more at the center of climate negotiations. But yeah, so I will say cautious optimism is the feeling here.
Cautious optimism. All right, I can take cautious optimism, and I'll be interested to hear what the others think about that. But yeah, I mean, plenty to be excited about. Plenty of ambition, as you say, a race to the top when we think about competition between across the pond, which is very useful. I'm going to shift a little bit into the EU and talk to Brian from Kaya Advisory about the GDIP. Our latest acronym, the Green Deal Industrial Plan. Kaya has previously reported on IPR, for IPR, on the impact of global industrial and trade policies, and particularly on the US Inflation Reduction Act and the EU's responses, this competition we've been talking about. So, Brian, you've produced a special report for IPR for investors closely looking at the EU's GDIP. Many announcements over the last 12 months, very hard to keep track of, a lot of acronyms, as we've said. So can you give us a little overview of the GDIP? Where does it fit in under the umbrella? I know you've got some slides for us as well that you might help us unpick this, all the many knots that is the EU policy work. Thanks, Brian.
Absolutely. I'm going to make this very exciting for everyone. All these acronyms just leap off the page. So yeah, I do have some slides. I'm not sure if, they're being brought up now. That's fantastic. So just in brief, this GDIP, the Green Deal Industrial Policy, is definitely the EU's response to what the US did last year, which is the Inflation Reduction Act. And in short, it's industrial policy, a policy to support clean energy industry in Europe. And for IPR last year, we wrote a paper called Race to the Top, which discussed the coming competition between the US and the EU in clean energy technology as a result of the IRA. And we've updated this paper looking at the GDIP specifically, and we phrased the paper by asking 8 questions on behalf of investors as to the importance and what it is. So I'm just going to set the scene, and pardon everyone, I'm going to ask slide flipping as we go along. So if we could flip to the next slide. So this chart shows the importance of this moment. It is a competitive threat to the EU. And what it shows is that since the IRA was announced, you've had $70 billion of total clean energy investment announced to go into the US, worth 65,000 jobs. Batteries, which is the orange bit, if you can't read the legends, is the lion's share of that. And that has occurred to the detriment of the EU. At the same time, the EU is losing a lot of investment. So the global share of battery investment into Europe went from 40% in 2021 just to 2% in 2022, and that's after only 4 months of the IRA. So a concerted counter narrative to the US getting all of this investment was needed, and the GDIP is the attempt to do that. And if you could flip forward, we're going to look at who is investing this money. And of the 70 billion which has been announced, half has come from Asia. China is definitely there. For those who are not thinking it's involved, it is involved. And that's over half, 40% is the US companies, but only 7% from Europe. And so the way that we're looking at this is that there's a lot of dry powder left. And European companies themselves can decide whether they want to keep that at home or they want to invest in the US. And we see this as there's still being time for the EU to act, but they need to transition what is policy design into effective policy delivery. And that's where the interesting stuff will happen. So if we go to the next slide, we'll get to a first question, which we ask, and just to go into a little bit more detail and putting this GDIP into context. If you look at the Green Deal overall, which is the legally enshrined climate goals of the EU, broadly speaking, we see it as three objectives before. One's emissions reductions, and there you have the weapon of the Fit for 55. There's 15 legislative files on that for everyone's headaches. You have sustainable finance, which has EU taxonomy, SFDR, CSRD, you get the point. And then you have circular economy, which is another 10 legislative files. All these are moving all the time, very difficult to follow. But into that now is a new dedicated industrial policy specifically designed for clean energy. And there's 4 pillars to this, as Kavita referred to. There's regulation, skills, funding, and trade. And the 2 most important new elements of this whole construct are the 2 under regulation called Net Zero Industry Act and the Critical Raw Materials Act. And there's a bunch of other things that are all brought together that are already existing, but for the first time, it's in a cohesive structure, which tries to mimic the appeal of the Inflation Reduction Act. And why does it matter? There's lots of reasons why it matters, but just to name a few, it makes the investment landscape for clean energy much more attractive in the EU, which brings in the jobs, the investment. It helps to establish energy security. It also creates let's say a promotion of competition between member states. So they're getting a bit of FOMO now because they can use increased flexible state aid and they can try to attract all these jobs. And what we're certainly seeing on the ground is interest for them to do it. And lastly, there's what you're looking at here in this colored bit is essentially a new economic security doctrine, which the EU is putting together. And the linchpin, what defines that, the binding ingredient, is the holistic usage of trade mechanisms to defend the whole thing. So if we go forward to the second question, which we go into in the paper, and this paper is only 12 pages, it's not 50 pages. So if you want to go read it, you can. But the second question is which sectors reveal the greatest policy ambition? And here we look into the Net Zero Industry Act specifically. And for those who don't know, there's an overarching target of at least 40% of manufacturing of net zero technologies to be produced in Europe by 2030. And below that, or they give 8 specific technologies, and 6 of those have quantitative targets attached to them. We list those 6 here, what's installed capacity now, as well as the ambition for manufacturing capacity by 2030. And just to give you a sense, I mean, each of these has a deeper story attached to it, but there's, let's say, the heat pump ambition is relatively unambitious, whereas electrolyzers or carbon capture and storage or batteries would certainly see more ambition, and even solar panels. It doesn't look like wind has a lot of ambition, but actually it does, because it's grinding to a halt at the moment. So, that's a bit of where they're targeting their ambition. It's a tell in a poker game a little bit. This is what we want to do. And if we go to the next question, it's a bit of a leading question. Will it be successful in catalyzing clean tech investment? And what we wanted to tease out in this is that the GDIP is a recognition that what existed before was not working. It was essentially flawed. Regulation heavy backdrop, long permissioning, lots of sticks, what you can't do, hurdles, and the market signals have clearly said no interest, and we'd rather go somewhere with incentives and where it's a lot easier to do business, which is the US. So in that sense, the GDIP is definitely a counter narrative and a positive development, both against the Inflation Reduction Act and against the Chinese and what they've accomplished. But there's some things that are uncertain and need to be addressed. And there's 3 examples here. There's no new money. It's repurposed money from existing funds. And that's important because the Inflation Reduction Act, at least on paper, is unlimited amount of funds to give to qualifying businesses and manufacturing processes. Also, that there's a lot of targets in this. There's a lot of goals, but there's relatively fewer plans and critically less enforcement of those plans should the member states not meet them. So it's all well and good having goals, but if you're not going to enforce them, that needs to be fleshed out. And the last element is time. The whole GDIP is a commission proposal, and it has yet to be negotiated by and between the council and the parliament. And by the time that gets done and dusted, you're looking at 2024 before you go into European parliamentary elections. And so looking at a year on an investment time cycle when 70 billion is flooding into the US, that's a significant element to take into account for investors. The next question we ask on the next slide is permitting reform the new secret weapon? And just to put this in context, historically, permissioning has been a huge impediment everywhere, but certainly in Europe. An average renewable energy project would take between 2 and 5 years to do, sometimes 10 years for wind, and up to 15 years for a new mining project. So the GDIP is taking this on via the NZIA and the Critical Raw Materials Act. And in the first instance, slashing them down to 18 months and 24 months, but also providing different categories of strategic importance or priority or in procedure, and also putting the onus on member states more than before. So they're saying if you don't respond to this within a certain amount of time with objections, then your silence tells us loads, and we're going to give the approval. Obviously, there's some caveats within that, but it's a big on paper move. The big question will be enforceability to member states. What are they going to do if they don't meet it? Are they going to sanction them? Is it going to be you don't get any EU funds? So that's a little bit unresolved. But on paper, it's definitely a competitive advantage relative to the US, where there's no movement on permissioning. The states still have a lot of power relative to the FERC, for example, and that needs legislation to change. It may happen. There's some chance it will happen, but as of yet, it has not. If we go forward one more, can the Critical Raw Materials Act address the EU's mineral needs? I mean, no, but they cannot do nothing. So what they're doing again is they're setting targets and extraction, processing, and recycling. And we give you the numbers here. What will be very interesting to watch is this 4th one for sourcing. What they're saying here is no more than 65% of any strategic mineral at any point in the value chain can come from a third-party country. So that's all well and good, but when 80% of polysilicon and 98% or 95% of a rare earth come from China, then will you really see by 2030 a disaggregation of the processing of those critical raw materials away from China? And so that's an open question, and it seems difficult, but that'll be interesting to watch for the build out of domestic industry in the EU. And I think the last one I want to go into for the sake of time is the next one, which is how does Europe's new industrial policy incorporate ESG? It does incorporate ESG, but they don't call it ESG, which is probably a great marketing thing. They call it resilience and sustainability. and those elements have weight, and they also encompass lots of objectives. So, for example, up until now, to get access to public procurement, which is huge in the EU, it's 14% of GDP, then basically it was about price. So if you're China, a Chinese company, and you're operating with a lower cost input model, you could win most of the projects that you wanted to get. But as of now, you have to establish between 15 and 30% of the weight of the bid in these sustainability and resilience measures. So those aren't defined, and member states will choose to do those differently, and it will adhere to the objectives of a given member state. So watching, that's going to be a non-price development. Will they be binary? Will they be non-binary? How much will it impact the fact that it's just a price-driven thing? It's going to be a great, sort of thing to follow and analyze, and the success of getting public procurement money from the EU. I'm going to stop there. Lots to dig into for investors in this new plan.
Amazing. Thank you so much. That is a really useful summary. And we will be, I think the link might already be posted, but if not, we'll be posting the link to that in the chat or elsewhere. So yeah, thank you so much for that summary. I'm going to bring in Alex again here to bring in some of the investor view. What are investors' views on the GDIP? What's that you've been hearing? Yeah, it'd be good to get their views, or your experience of their views anyway.
No, happy to generalize as well as be specific, but I would say that for us as the sustainable investor for a changing world, we welcome a large majority of these policies, and when taken together with the CBAM, and which was just the carbon border adjustment mechanism to avoid extra acronyms that are unnecessary, and many of the other regulations that are, and European trading mechanism, trading scheme for carbon allowances in Europe. The suite of policies in the continent are incredibly strong and are moving definitely in the right direction, and I think will be generally quite supportive of companies that we like to invest in that are driving the sustainable transition to a low carbon economy. And these are companies that are working in the hydrogen ecosystem to build out that infrastructure and related technologies. There are companies working in traditional renewable energy sectors as well as non-traditional or alternative renewable energy sectors. This is companies working on food waste reduction and on alternative means of food production. So it's a very dynamic landscape, and we're excited to be investing in it. And I think these incentives will, as they take hold, the incentives in the overall suite of European regulations, as they take hold, they will drive outsized growth for companies that are producing the right solutions to these industrial problems. And I think the investors that are owning those early will benefit the most from that growth. And I think that is definitely something that aspects or parts of the market are coming around to and recognizing. And so, generally speaking, I'd say that GDIP is a positive for sustainable investors. Though on a more broader global basis, if you look globally at capital flows, there's still not enough capital from private investors going into sustainable opportunities in a meaningful way. In part, there's not enough sustainable opportunities to go around in some cases as well. So we have to do more. We have to expect more from our counterparts in the investment industry, as well as our policymakers that we work from, or whose frameworks within we operate. So. Yeah, it's a very high level answer. Happy to provide more detail maybe in the Q&A.
For sure, thank you. That's really useful, and we're going to move on from GDIP in a second, but there were a few questions which Brian has very kindly answered by text. So one of them was around the UK and what's happening there, and you can go and have a look at those in the chat box, because I don't want us to run out of time. So thanks, Brian, for doing some typing in the background there. That's very helpful. I want to move on to Mark, and really the topic of this webinar and the hook, as it were, is 1.5 degrees still achievable? So Mark, let's cut to the chase. You've been doing a lot of work on this, and you've penned a post recently on this. Is it still achievable, straight pathway, or tackling overshoot? Can you give us your thoughts?
I think hello everyone. I think actually I think you were going to ask me, what is overshoot? And overshoot is a word that, if you were a scenario nerd, which I partly am, a couple of years ago, you were right over it. What happens when or if the temperature overshoots a certain target in 2100. So anytime between now and 2100, where all temperature models settle, what happens if it overshoots? It goes above the temperature. Of course, the IPCC has now raised the notion of overshoot right onto the front pages because they're talking about it. So that's the background to what I'm about to show you. Let me share my screen. So hopefully you can all see that. So essentially, have we got much time? Where are we at? How much time have we got to achieve 1.5C? Well, not a lot. And it's not just the time, it's the trajectory, it's the steepness. These are simplified emissions pathways where you just take, where are we today? We straight line it to the net zero that is consistent with the particular scenario. It won't look like that, it'll wiggle all over the place, but it's just a fun way of sort of just making the point. So if you want to hit 1.5C at 66% probability, you've got until about 2039, and it's like falling off a cliff. If you want to do it at 50%, it's a little bit better, but you're probably off the same cliff. You go for 2 degrees, and well, I've got all the way up into 2070 something at 66%. And I would say to you, if we don't hit 2 degrees, that's ridiculous. We will hit 2 degrees, that's for sure. You look at this stuff, and we've got enough time for our technologies to adapt to that. But can we do 1.5? That's a really big ask. And the reason I mention this is that when we're on a very sort of an area which people are very uncomfortable with. Oh, can you talk about dealing with overshoot and how you deal with it? And if you do that, will you then disturb everyone trying to do the green line after all? The reality is that time's running out. The UK Met Office produced a study earlier in the year which said there's a 50-50 chance of us hitting 1.5 in 2025. Now, I don't know if you've all seen, there's been some scientific research that's come out last couple of days. The ocean warming has just gone berserk. They don't know quite what's going on with the oscillation. If that heat gets released, the El Nino is over, as we know in Australia. I can tell you we're going to get a big jump in temperatures potentially coming very, very soon. So how should we look at getting to 1.5 though? So I will say, yes, of course we can get to 1.5. Actually, it's a question of how you get there. If you want to go on so this chart came from the IPCC report of 2014, AR5. And I always love this because it shows carbon budgets to achieve 1.5C. And it's very simplified. The new one's got 8 of these. So this one's nice and easy. Essentially, it shows you what they call P1. That's like a very low overshoot, almost no overshoot. And that shows you, again, a very steep trajectory down and a little bit of negative. Now, so these AFLU and BECCS, back in the day, bioenergy CCS was the negative emission technology. That was the thing that would remove carbon. Those are the removals, right? So essentially, P2, I've got a bit more time and I've got more BECCS. P3, I'm starting to build quite a lot of BECCS. And in P4, wow, we ain't done much and we're massively overshooting. And we need lots of negative emissions technologies. But note, each one of those gets you to 1.5, but in different ways. And I've always said, if you're an investor, if you don't get the pathway right, you know, that's what you're investing in, the pathway, not the end, actually. So essentially, this shows you there are many, many ways of getting there, okay? So that's the first point. And we obviously think that P1 is going to be extremely hard. So is P2, but P3 may be interesting. So where's the problem? I always show this chart. And again, I have to be very cautious because everyone goes a bit unfair, isn't it? So the non-OECD is already more than double the emissions in 2020 of the OECD. And we actually forecast, this is our forecast policy scenario, which uses all that work that Kavita was talking about, but it's our 2021 forecasts. And we think the OECD gets to net zero in 2050 quite rapidly, reasonably rapidly. But you can just see just the vast overshoot in this sense, or excess emissions that are generated in the non-OECD. And obviously China is a very big part of that. And so this is the core of any overshoots, and in our opinion will be how will the non-OECD operate, right? So what we also did is we have a second scenario called the required policy scenario. And the required policy scenario is, what do you need to do to get to 1.5 low overshoot? It's a P1. So everyone wants to look at this. So we thought we'd do one last year. But what was interesting to us is we're then able to calibrate the policy differences and the sector differences. So essentially, you know, China needs to phase out its coal fleet 10 years earlier under a 1.5 low overshoot. And that's the largest saving it'll ever get. The Chinese coal fleet is 12% of global emissions. The Chinese coal fleet is bigger than the US economy. And if you don't have a solution for the Chinese coal fleet, you don't have a solution for the climate problem. Then we get into end of deforestation. Now, in our forecast, it's 2030, but actually you need to do it in 2025 if you're going to hit 1.5 in our view. And then it's 100% clean industry in China, coal phase out in India, clean industry in India, MENA, China, Indonesia, Southeast Asia. There's no major lever in the OECD that you need to mega close in order to get to 1.5 low overshoot. So far, how do you get these countries to do this, this massive policy acceleration? I mean, you want to get to 1.5 low overshoot by 2050 or 45 or whatever, you've got to have a massive non-OECD policy acceleration if you don't want to use negative emissions technologies. So what are carbon removals? We used to call them nets or CDR, carbon dioxide removals. That was used by the academics more. Nets, I like negative emissions technologies. But what we're noticing is the word carbon removal or removals is the word that's really emerging, and it's gone big this year, very, very big. Just Google the word carbon removals, right? And essentially in that you've got these interlocking areas, but the really important ones are NBS, nature-based solutions, afforestation, land management, oceans. Then you've got in the carbon capture world, you've got BECCS and DACs. So you've got CCS as the underlying technology, which everyone has hated, but I'm afraid, you know, it's coming. And I'm glad it's coming. And the real negative emissions technologies are bioenergy CCS and direct air capture. Now, bioenergy CCS always causes some consternation because it's competing in the land system. And we've written a great deal about that. So we're always a bit cautious about how much bioenergy CCS is sustainably deployable. We are doing a further study this year on the bioenergy sector. Vivid McKinsey is doing that. I think it's going to be an extremely interesting study where we really dissect the intersection there and really understand how much really the land system can give to energy in much more detail. Now, I'm going to declare my favorite, and it's the most expensive, is direct air capture or DACs. And that is basically, if you've got a reservoir, you can put a little machine next to it and pump the carbon in. It's expensive. $600 a ton at the moment, but coming down rapidly, I suspect. And if you're Saudi Arabia and you want to take 1 cent solar, build massive DAC stations and pump those DACs into your oil reservoirs, that might be a very much cheaper project. And trust me, they're looking at that. So what could we then do? Could we say we took our forecast, which if I go back to what Kavita said, as Brian often says to me, we're a bit boring because when everything comes out that everyone's excited about, we go, yeah, well, that's sort of in line with what we thought might happen. It's a bit boring, I agree, but it's exciting that we can get well below 2 degrees, but we always thought you could. I mean, we felt the inevitable policy response, we would get below 2 degrees. And it's tracking along. It's not all there, but it's tracking along reasonably well, right? So I think that in a sense, 2 degrees is actually, in my view, the upper limit, and maybe ratcheting down even below that. But getting to 1.5, that's just a huge challenge, right? So what we said is, how much negative emissions or removals do we need to put on top of our forecast? So the additional nets are about 500 gigatons, they're not small, between now and 2100. So that would be how the IPR FPS would then become a 1.5, and it would then overshoot. You can only overshoot if you have an end target. You know, so once we say, yes, 1.5 is where we want to go, in a combination of what we forecast plus what we then need out of the removals, we overshoot at about 1.7. So we undershoot a little bit under the 1.8 that we're currently at, but then we come back down. How believable is that? And that is the $64,000 question that we're exploring further this year. How much DACs could be deployed at what price? How much BECCS could be deployed? What are the other negative emissions that also make sense that are coming on stream? Now, as I say, everyone gets very nervous in this topic. They go, oh my goodness me. So we think, we've been exploring with Carbon Tracker, some rules, if you like, which would say that that negative emissions technology should be mostly reserved for overshoot. If you can do that, right? It's got to be a government program ultimately to do that, right? I think. And what you should do is deploy them as the overshoot occurs. So you should limit the overshoot. Maybe the overshoot isn't as big. Maybe we can get bigger wedges earlier if governments take action and go, yeah, we need to get this stuff out as the overshoot begins. So we don't want to be irresponsible about this. We don't want to take the foot off the pedal to get the underlying FPS as good as it can get. But are we going to sit here when we're overshooting and go, oh, well, yeah, you know, so, well, let's hope they get it right soon? No, we've got to take it out now. We've got to take this stuff out when the overshoot begins, and the overshoot may not be far off. So the other thing you do is you develop the CCS technologies and so on in the hard to abate sectors, because they need them anyway. You know, even John Kerry's going, oh, we need CCS on gas, you know. So essentially, we go for the hard to abate sectors, we develop and scale. The direct air capture we need to is starting to scale. The oil companies are all looking at it, right? They've got the reservoirs and the IRA has given $180 a ton subsidy. Now, you know, it's still expensive, but as the prices come down, I think the governments can do better there. So I know I'm overshooting a bit. All I'll say is we still expect the land system, the nature-based solutions to be massive. They have to be so. And so essentially, policy needs to accelerate dramatically, particularly in the non-OECD, dramatically now, right now, to get to a low overshoot 1.5. We think policies should start to, like the IRA, start to develop the backstop, whatever you want to call it, the hard to abate sectors, the backstop. Let's get the backstop in place so we're not scrambling when and if, and I think when, overshoot takes place. And I'm developing an idea just a little bit further that DACs could solve the north-south issue. Why? The OECD removes its historic emissions. It takes responsibility for its carbon budget, and it creates room in the carbon budget for the non-OECD. So that's an interesting idea, I think, that we want to develop as the year goes on. Thank you very much. So I overran a bit.
No problem. Thank you. And you've left us on a cliffhanger there. Very interesting. And yeah, keen to get some of the other panel's views. We are always short on time, as is the way. But I just wanted to quickly, get a few broader questions from the panel on some of the topics that Mark raised and some of the other areas. I guess right now, where do we think we are? Policymakers in front of or behind investors, right now where we stand? Alex, you've done some work on this. What are your thoughts?
Well, I mean, given where we are in time, I think I might pivot a little bit and just address the sort of elephant in the room. There's a lot of discussion within investor circles. Some of it's genuine debate, some of it's less genuine, but about the merits of, say, some of the net zero commitments that many of us have made, and whether now that 1.5 degrees without overshoot seems hard to achieve, whether it's the right framing for our collective ambition. I mean, from my perspective, I would say that it very much remains the right framing. 1.5 degrees was never a precise target. It was always an aspirational goal. Even with reaching net zero in 2050, we only have a certain degree of certainty that we would achieve 1.5 degrees at that level. So it was always aspirational. Every degree of warming that we avoid, and every emissions ton of emissions that we avoid putting into the atmosphere, improves outcomes in the real economy and in the real world. And absolutely, we should continue to push on this envelope. We cannot abdicate our responsibility as investors to policymakers. It's not how it works. We all need to work together and move in the same direction to push for a lower carbon economy. And then another thing I'd mention too is that as policy, it is accelerating in many areas, but as Mark just pointed out, there are a lot more still needs to be done. The longer that we delay action on those areas where action is required, if we believe, as those of us on this panel certainly do, that the policy response is inevitable, eventually the transition risk will come to roost, and the longer that it takes for us to act, the more severe that action will be, and the more trenchant the stranded asset risk, which for investors left holding those, hot potatoes or whatever analogy you want to use, that they'll feel that pain more in that circumstance. And so investing now, being early, supporting the transition, finding the solution providers that are really driving the change that we want to see, and then working to avoid and manage that downside risk from a policy response is going to become a preoccupation. It needs to become a preoccupation for all investors over the coming years and months, years and decades.
Thank you. Kavita, I wanted to talk about, we've had a few questions in the chat thinking about how realistic is everything. So there's a question about how realistic is certain removal technologies. I don't know if you're a technology specialist, but it did strike me from, the work that you've been tracking and the acceleration. There is the question that people often ask me is, how realistic that we're actually going to see. So certainly there's lots of paper floating around, there's lots of things happening on paper, but how realistic is that there's action actually going to come out of all the policy environment that's taking place? So it'd be interesting to get your views on kind of how realistic is this versus optimistic.
So I think and I think Mark discussed how the IPR sort of well below 2 degree scenario, it's the 1.8 forecast policy scenario, is a realistic assessment of sort of how policies are likely to unfold. That doesn't mean it's going to be easy to do, right? And so we talked about how there are commitments or policies, but the funding is still adequate. It's good to see the funding. There's never going to be enough funding, right? So we think it's a realistic pathway that's achievable. We see cost reduction. I think in the last year or so, we've seen EV deployment kind of surpass expectations. And we're only seeing more and more dollars on the table or funding on the table to sort of drive down costs. Brian discussed battery technology being the flow of funding. So what we think to a degree is realistic. I think we talked about the word boring. I'd like to use the word relieving, I think, right? So we're seeing evidence we're on that path. And then we're hoping to see more and more shifts towards that right-hand side of that matrix. So towards 1.5. And there's a question there on, right, cost reduction pathways. Still seeing very high costs need to be driven down this decade to kind of unlock the emissions reduction in 2040 and beyond.
Yeah. And then Mark, also is coming up in the chat, there's, the slides you put up about OECD levers being very few and far between. So there's kind of two related questions to that around, the embedding of emissions within of OECD emissions within non-OECD countries. How do we deal with that? How do we look at that? And what should OECD countries do more of? One suggestion was around sanctions, more than CBAM, for example. So kind of those two related questions on those charts that you raised around those levers.
Yeah, well, look, I mean, again, I'm going to for interest, argue this what at the moment might seem a strange idea, but I've got a feeling it might get some legs, which is that the OECD has outsourced its emissions, right? Okay, and it's created a lot of emissions historically. It should tackle them by taking them out, make room in the carbon budget, right? So that is, I can give you 1,000 other, transfer money. There's all the stuff about, but I think I'm sort of the first person beginning to call for creating room in the carbon, not the first, but I'm certainly calling for creating room in the carbon budget. And we need to do a lot more work with our, Sean Kidney and Climate Bonds is very interested to think about it. I've got lots of people saying we need to develop this idea. I'd like to talk to I thought it was a great comment, in the chat, relatively small allocations, 5% of book, but some good opportunities out there. If only the narrative about when to deploy nets would become less charged. Yeah, well, people like me are about to take it on the chin, aren't we? To try and make it less charged, make it a rather sort of yeah, okay, guys, we get it. You got to keep on. And I think when people say, oh, well, you're only now going for 1.8, we're not going for 1.8, we're calibrating it at that level. But as Kavita said, that ain't still in the bag. And that's extremely hard. There's a lot of work to be done on the ground. The one thing that Brian and I talk about, I'm the advisor to quite a large green infrastructure fund in America. And let me tell you, the IRA is great, but they need to get the panels, they need to get the workers. The Chinese supply chains are drying up. It's not so great on the ground, right now, and that's short term. But I'm saying, there's a lot of work to be done to make this happen. And look at Brian's analysis of GDIP. It's it's good. I say, I like the racing analogy. It's yeah, okay, the OECD is actually on the track. They've got a massive handicap called they can't create tax credits, but they think they're going to come roaring from the back with secret permission policy. But there's a long way to go in this stuff. We think the OECD will get there. China, I think, will crush its emissions eventually. It will get there, but not fast enough for overshoot, I suspect. As I say, the Chinese coal fleet getting to net zero in 2035, that's a big ask, right? And they're still building it. So I don't know. So I think that we've got to give room to the developing world, I think, and we've got to stop this. I think it's time to say, look, let's develop nets in hard to abate sectors. Let's understand everyone wants to reforest. That's a net. Why don't we then say, yeah, what's wrong with direct air capture, getting it ready as a backstop, as an insurance policy? Why are we so scared of saying that when actually doing the opposite might create existential risk? This is what I really worry about. So if we do overshoot big, and we haven't really developed at scale, they're going to spray stuff out of jet engines. And we don't know what's going to happen. You're going to get real geoengineering if this thing gets out of control. So let's get it under control. Let's use technologies we understand.
Indeed. Well, I wanted to bring you in, Brian, because I know Mark mentioned your name a few times. We are running out of time, but I don't know if you could add your comments to that, and maybe also think about kind of the next, the big future global policy outcomes, what we see going forward.
In the last minute. Okay.
In the last minute. I'll give you a bit more.
Yeah, I mean, I'll just to give a little bit of controversy at the end. I think the COP is losing its, let's say, preeminent status as being the channel for holding this together and making progress. I think there's going to be more multilateral and bilateral support and competition for support and competition for funding these initiatives in non-OECD countries. World Bank reform is a massive topic right now, and the US administration is getting the most, let's say, momentum that it's had in years. So I think there's going to be other avenues other than COP, especially when they're in regions which have a lot of fossil fuels, and they've kind of become a trade fair on the side. So I would look for those other channels. I'll just leave it at that.
Thank you. Kavita, any last thoughts? What's coming up next for IPR in the future?
So we will be issuing quarterly forecast trackers again as part of these quarterly briefings. I think the next one's slated for July, perhaps a bit more detail on the website. We've got a new website, everyone should check it out as well. We're also hoping to do a sort of a updating, a refresh of the scenario as well.
Thank you very much. I know the website does look great, so I can attest to that. Alex, a final word from you. What do we expect going forward, and what are investors' thoughts going forward?
Yeah, I mean, now's not the time to take the foot off the gas. Maybe a bad analogy, but given what we're trying to prevent. But now's the time to keep doing more as investors. Let's not take our eye off the ball there. Now I'm really mixing idioms, but yeah, that's the main point in seconds that we're over already. So.
Well, thank you so much, everyone. I think the conclusions are very clear. We need, without further acceleration in global and national policy settings, we're seeing them, but without that scaling up of climate and transition-based investment, 1.5 degrees is going to be very challenging. We know that. Overshoot and carbon removals are kind of part of our regular vernacular. They're in the climate narrative now. It's a huge part of all the discussions going forward, and sometimes we need to, as Mark said, take the tension out of them and discuss them on their merits. So both policymakers and investors will need to address capital flows into these technologies, and that is going to be a hugely critical part and just one of the tools that we will need to utilize. There's no shortage of ideas. We've just released 101 sustainable policy solutions, which came out yesterday. There's plenty of different ways to tackle this, and I recommend it. We'll put it up as well. But I'll end there and say thank you so much to our panelists, Kavita, Brian, Alex, and Mark. It's been a great session. As always, way too much to discuss. We had some great questions that we weren't able to get to. But thank you very, very much, everybody, for asking them. It shows that you were listening. So thank you to my panelists who kept everybody very much entertained. So until next time, thank you.
Thank you.
Thank you.
Thank you.
Thanks. Bye.